Before we start, I need you to do two things for me right now. First, hit the like button, because this video is going to save you years of confusion and possibly thousands of dollars in mistakes. Second, subscribe, because the truth is, nobody teaches this in school for a reason. And once you finally understand how investing works, you're going to realize the system didn't want you knowing this too early. Now listen, if you've ever felt like investing was only for rich people, or for finance nerds wearing suits, or for those Wall Street guys that speak in code like earnings, portfolios, derivatives, blue chips, volatility, then I want you to breathe for a second. Because the stock market is not complicated. It's just explained in a way that makes you feel dumb on purpose. It's like they're talking in another language, and when you don't understand it, you assume you're behind, when really you were never taught. So today, I'm going to teach you investing the simplest way possible, like you're 10 years old. No confusing words, no fake motivation, no buy my course, just the truth. And by the end of this video, you will understand what stocks are, how people actually get rich from investing, what beginners should buy, how to avoid getting scammed, and how to start in 2026 even if you feel totally clueless right now. But first, I need you to understand the biggest secret of investing. The stock market is not a casino. It's not a get-rich-quick scheme. It's literally just a marketplace where people buy pieces of companies. That's it. That's the whole thing. And once you understand that, investing starts to feel almost stupidly simple. So let's start from the beginning. Imagine you own a lemonade stand. It's going great. People love it. You're selling lemonade every day. But now you want to expand. You want to buy more supplies. Maybe hire friends to help. Maybe open another lemonade stand across town. The problem is, you don't have enough money. So what do? You have two choices. Option 1 is you borrow money, like taking out a loan. Option 2 is you ask people to invest in your lemonade stand. And here's how investing works. You tell people, hey, if you give me money right now so I can grow my lemonade business, I'll give you a small piece of ownership in my stand. That means they now own a piece of your business. And if your business grows, their ownership becomes worth more. That's the stock market. Stocks are just small pieces of ownership in a company. So when you buy Apple stock, you're buying a tiny piece of Apple. When you buy Tesla stock, you're buying a tiny piece of Tesla. When you buy Microsoft stock, you're buying a tiny piece of Microsoft. And this is why no single person owns Apple. Apple has millions of owners, and those owners are called shareholders. So every time somebody says I invest in stocks, they're really saying, I buy small pieces of businesses. Now here's where the game gets interesting. Because when a company grows, two things can happen for the investor. First, the value of your stock can go up. If people think the company is more valuable today than it was yesterday, then your share becomes worth more money. So you could buy a stock for $50, and later it might be worth $70, $100, $500, depending on how well the company does. But there's a second way investors get paid. And a lot of beginners don't even know this exists: dividends. A dividend is when a company makes so much profit that it rewards shareholders by paying them part of those profits. So some companies will literally pay you just for owning the stock. You don't have to do anything. You don't have to work for it. You don't have to sell anything. You just own shares, and the company sends you money. Passive income in its purest form. And this is why so many people become wealthy from investing, because they're not trading and gambling every day. They're owning businesses and letting time do the work. But now comes the part where most people get stuck. They say, okay, I get what stocks are, but how do I actually buy them? And this is where the modern world makes it easy. You don't need a suit. You don't need a Wall Street connection. You don't need to be rich. In 2026, the stock market is literally in your phone. All you need is a brokerage account. A brokerage account is basically the app or platform that lets you buy and sell stocks. It's like your investing store. And once you open one, the process is simple. You put money into the account from your bank. Then you pick what to buy. Then you press buy. That's it. The problem is, people overthink the whole thing. They think investing is about knowing secrets. But the biggest secret is consistency. Let me tell you something nobody wants to admit. Most people don't lose money in the stock market because they pick the wrong stock. They lose money because they panic. They sell at the worst time, or they buy random stuff they don't understand. Or they treat the market like a casino. And this is why I want you to understand something important right now. There are 4 main styles of investing, and you're going to see yourself in one of these. The first style is the buy and hold investor. This is the person who buys good companies or funds and holds them for years. Not days, not weeks, years. Sometimes decades. Some people literally invest until they die. That's not a joke. That's generational wealth. They pass the stocks down to their children. And this is the easiest method for most normal people who want to build wealth without stress. The second style is trading. Trading is when you buy and sell frequently. You're not buying a company because you believe in its future. You're trying to predict short-term price movement. And I'm going to be honest with you. If you're a beginner, trading is one of the fastest ways to lose money. Not because you're dumb, but because trading is a skill. It takes years to master. And most people aren't beating professionals who do this for a living with supercomputers and insider access to information. So if you're brand new, you can trade later when you understand the game. But for now, do not treat investing like a lottery ticket. The third style is speculation. This is when people buy small risky companies hoping it explodes. This is the "this stock is going to the moon" crowd. And sometimes it works. Some people speculated on Tesla early and became rich. Some people speculated on Amazon early and became rich. But some people speculated on random companies and got wiped out. So speculation can make you rich, but it can also humble you very fast. The fourth style is dividend investing. This is where people buy stocks because they want cash payments from dividends. They want their money to pay them every month or every quarter. And then they reinvest those dividends to buy more shares, which creates more dividends, which buys more shares, which creates more dividends, and it becomes a snowball. This is one of the most powerful ways to build long-term wealth, because eventually your portfolio becomes a money machine. Now at this point you might be thinking, okay, but which stock should I buy? And this is where most beginners ruin everything. They go searching for the perfect stock. They want the magic cheat code. They want the one investment that makes them rich overnight. But I need to tell you something that might disappoint you. There is no perfect investment. Even billionaires don't have the perfect investment. Even hedge funds lose. Even Wall Street gets it wrong. In fact, I've seen huge investors blow up their entire portfolio over one perfect bet. So instead of chasing perfection, we focus on the real cheat code for beginners: diversification. And this is where we introduce one of the most powerful beginner tools in investing: index funds. Because instead of you trying to pick the perfect company, index funds let you buy hundreds of companies at once. It's like buying the whole market in one click. And this is why so many financial experts recommend index funds for beginners. Because it removes your emotions. It removes your guessing. It removes your ego. And it lets you in slowly, which is how people actually get rich. But here's the plot twist that most people never hear. The reason investing makes people rich isn't that they make a lot of money. It's because they invest consistently and let time multiply it. The stock market rewards patience more than intelligence. And the earlier you start, the more unfair your future becomes. And that's why this video matters. Because right now, you may feel behind, but truthfully, you're early. Most adults never learn this. Most people go their entire life working, saving, struggling, and never understanding that money can work without them. But now you're learning the code. And in the next bundle, I'm going to explain something that will change how you see money forever. Because once you understand what a mutual fund really is, and why Wall Street loves confusing you with terms, you'll realize the system is built to scare beginners away from the easiest wealth-building tool on earth. So here's what I want you to do. Comment below: I'm starting to invest in 2026. Even if you haven't started yet, claim it. I'm going to show you exactly what accounts to open, how to set up your investing like a beginner, and what to buy so you don't mess it up. And once you see it, you're going to realize this was never hard. It was just hidden. Alright, now that you understand what stocks really are, we need to talk about the biggest mistake beginners make. Most people think investing starts with picking a stock. They think it starts with Apple or Tesla, or some random company their cousin mentioned at a barbecue like, "Bro, this stock is about to go crazy." But investing does not start with stocks. It starts with something even more important. It starts with choosing the right account. And I know that sounds boring, but this is where people accidentally lose money without even realizing it. Because the account you choose is like the bag that holds your investments. If you pick the wrong bag, you could end up paying more taxes, getting penalized, or not being able to touch your money when you need it. So let's explain this like you're 10. Imagine you go to the grocery store. You don't just walk in and start grabbing food. First, you pick something to carry it in. Some people use a small basket. Some people grab the mini cart. Some people grab the big cart. That cart is your investing account. It's not the food. It's what holds the food. And that's exactly what an investing account is. It doesn't make you money by itself. It's just a container, a holding place, a tote bag. Now let's talk about the different bags you can use. There are retirement bags. These are the accounts like for 101ks, for 103bs, IRAs, Roth IRAs. The best thing about retirement bags is they come with tax advantages, meaning the government basically gives you a cheat code. But the downside is you can't just pull the money out whenever you want, because it's meant for your older self, your future self, the version of you that's tired, wants peace, and wants to retire without eating ramen noodles every day. Then there are education bags. Those are accounts like 529 plans. These are meant for saving and investing for a kid's future education. And then there's the most flexible bag, the regular investing bag. This is called an individual brokerage account. This is the one that doesn't have the retirement rules. It's basically your invest whenever you want and access whenever you want bag. Now here's why this matters. Because if you just jump into investing without choosing the right account, you can accidentally make it harder for yourself. So step 1 is not buying stocks. Step 1 is opening your investing bag. And in 2026, this is incredibly easy. You can open an investing account through big brokerages like Fidelity, Vanguard, Schwab, or E-Trade, or you can open one using newer apps that feel more modern. But either way, the point is the same. You're opening a digital investment account that lets you buy assets. Now step 2. Once you open the account, you have to fund it. This part is the simplest thing in the world. You basically transfer money from your checking account into your investing account. It's like moving money from your left pocket into your right pocket. Nothing magical yet. Still not investing yet. Just transferring money. Now step 3 is where the real fun begins. This is where you pick investments. And this is where most channels mess beginners up. Because they immediately start yelling things like, buy this stock, buy that stock. This stock is undervalued. This stock is going to explode. And beginners eat it up because it sounds exciting. But that's not how regular people win. That's how gamblers lose. The safest way beginners win is by buying something that gives you instant diversification, which means you own a lot of companies at the same time. That's what ETFs and index funds do. This is the cheat code, because instead of you picking one company and praying it doesn't collapse, you buy a basket of companies. So even if one company fails, you're still okay. Let me explain ETFs and index funds in the simplest way possible. Imagine you want candy. You can buy one candy. That's buying a stock. But if that candy tastes bad, you wasted money. Or you can buy the whole variety pack. That's an index fund. You get chocolate. You get gummies. You get lollipops. You get everything. So even if one candy sucks, the whole pack is still good. That's what an index fund is. It's a pack of companies. Now this is the part that makes people rich. Index funds, ETFs, mutual funds. They sound confusing, but they aren't. They just mean a basket of investments. And this is why billionaires and long-term investors love them. Because when you buy a basket of investments, you're no longer betting on one company. You're betting on the entire system continuing to grow over time, which it has historically done. Now I need you to understand something important. A lot of people talk about the best investment, but the truth is, there is no perfect investment. Even hedge funds with unlimited money fail. Even professional investors lose. So if billionaires can't always pick the perfect stock, why would you gamble your future trying to do it? This is why beginners should focus on owning the market, not beating the market. Because beating the market is what Wall Street sells as a fantasy. Owning the market is what builds real wealth. But now here's the part people skip: fees. Because even in the investing world, there's always a sneaky tax. Sometimes it isn't the government. Sometimes it's the fund itself. This is what expense ratios are. Expense ratios are basically the fee the fund charges you to manage the basket. And most beginners don't even know they're paying it, because it happens quietly. It's baked into the performance. It's like ordering food and getting charged an extra fee for bringing the plate. Now here's the good news. In 2026, investing fees are lower than ever, but you still have to pay attention. Because if two funds do the exact same thing, and one charges a higher expense ratio, that means the higher fee fund is slowly stealing your growth. Not dramatically, not in a way you notice today, but over 10, 20, 30 years. It can be life-changing. So you always want low-fee diversified funds. Now let's pause right here because I need you to understand what we've built so far. You open an investing account. You fund it with cash. You buy diversified baskets like index funds. That's investing. And yes, it is that simple. This is the part where your brain should be going, wait, that's it. Yes, that's it. The reason people don't invest isn't that it's hard. It's because investing feels emotionally scary. People think investing means losing money, but investing doesn't mean throwing money away. It means buying pieces of businesses that produce value. Now let's talk about the biggest fear beginners have. What if the market crashes? And this is where I'm going to tell you the cold truth. Markets crash. Markets fall. Markets get ugly. That is normal. That's not a bug in the system. That is literally part of the game. In fact, historically, the people who get rich are the ones who keep investing during the scary times, because that's when everything is on sale. Most people run away from the market when it drops. Smart investors lean in, but beginners panic because no one explains the real trick. The real trick isn't timing the market. The trick is time in the market, meaning the longer you stay invested, the more the market has time to work for you. Now I want you to listen closely because this is where I want to shift your mindset forever. Your investing journey is not about perfection. It's about progress. You don't have to be an expert. You don't have to pick perfect stocks. You don't have to know every financial term. You just have to start. Because most people never start. They stay in fear for 10 years. They stay in confusion for 20 years. They stay broke forever because nobody ever sat them down and explained the basics in plain English. But now you're different. Now you understand. In the next bundle, I'll show you the real starter plan for beginners. I'm going to explain what you should invest in first, how to pick beginner-friendly index funds, how to avoid the 3 biggest rookie mistakes, and how to start investing in 2026 without feeling overwhelmed or getting manipulated. Because once you understand what's really happening, you're going to realize the stock market is not scary. It's actually one of the only systems in the world where normal people can legally build wealth without being born rich. And once you understand the rules, the game starts working for you. Alright, now we're officially at the moment most beginners have been waiting for. Because now that you understand what stocks are, and now that you understand what an investing account is, we finally get to the question everyone asks. What should I buy? And I'm going to be honest with you. This is the part where the internet is filled with traps. This is where people start yelling stock picks like they're profits. This is where TikTok becomes a casino. This is where YouTube thumbnails start screaming this stock will 10x. And this is also the part where beginners lose money because they think investing is supposed to feel exciting. But here's a rule I want you to remember forever. If investing feels like adrenaline, you're probably gambling. If investing feels boring, you're probably doing it right. So let us build the beginner blueprint in a way that makes sense and doesn't destroy your bank account. First, I want to explain the biggest lie beginners believe. Beginners think the stock market is a place where you go to get rich fast. But the truth is, the stock market is a wealth-building machine, not a lottery ticket. And the people who get wealthy aren't the ones making crazy bets. It's usually the ones doing something simple again and again for a long time. And the simplest way to start investing is with index funds. Index funds are the beginner cheat code because they protect you from being wrong. See, when you buy one stock, you're betting that one company wins. That's dangerous. It's like putting all your chips on one horse and hoping the horse doesn't trip. But when you buy an index fund, you're betting that the entire economy grows over time. You're betting on hundreds of companies. So even if some companies fail, the winners carry the whole fund upward. And historically, the big markets tend to rise over time because humans keep producing, building, inventing, and consuming. Now here's what beginners should buy first. Not one stock, not 5 stocks, not the next Tesla. Beginners should start by buying a broad index fund. The most popular beginner-friendly index funds are ones that follow something like the S&P 500. The S&P 500 is basically a list of 500 major US companies. It's like owning a piece of America's biggest money-making machines all at once. Technology, retail, healthcare. Banks, consumer goods. Energy. You're not trying to guess the winner. You're buying the whole stadium. And one of the smartest moves you can make in 2026 is to start there, because it keeps investing simple and reduces mistakes. Now this leads into the next big truth. The stock market is not a straight line. It does not go up every day. Sometimes it falls hard. Sometimes it moves sideways. Sometimes it goes down for a year. And when that happens, beginners freak out because they think they did something wrong. But I want you to understand something. When the market drops, it's not the end. It's literally a sale. It's the market saying, everything is cheaper today. It's like your favorite video game suddenly putting the best items on discount. But beginners see red numbers and panic. Smart investors see red numbers and smile. Because if you believe the economy grows long-term, then a crash isn't a funeral. It's a discount. Now I'm going to teach you the best strategy for beginners. It's called dollar cost averaging. That's a scary phrase for something very simple. Dollar cost averaging means you invest a set amount of money regularly, every week, every 2 weeks, every month, no matter what. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, the strategy smooths out the chaos and helps protect you from bad timing. This matters because beginners love asking, when should I invest? And the answer is whenever you can consistently invest. Because most people who wait for the perfect time never start. They wait, they overthink, they scroll, they panic, and by the time they finally invest, the market already went back up, and they miss the opportunity. So the beginner blueprint is not timing the market. The beginner blueprint is building consistency. Now, we need to talk about the part nobody wants to hear. You will not get rich in 6 months. You will not get rich in a year. The stock market is not a magic genie. But here's the good news. It's still one of the fastest realistic ways regular people build wealth. Because you don't need to invent a product, start a business, or win the lottery. You just need patience and consistency. And patience is the rarest financial skill on earth. Now let's talk about the biggest enemy of beginner investors. It is not the market. It is not inflation. It is not interest rates. It's not even politicians. The biggest enemy of beginner investors is emotion. Because beginners panic when stocks drop. Beginners get greedy when stocks rise. Beginners chase whatever is trending. Beginners get bored when investing is working properly. And that boredom is the danger zone. Because that's when beginners start doing stupid stuff. They start buying meme stocks. They start buying random companies. They start making quick flips. They start turning investing into a video game. But real investing is not a highlight reel. Real investing is a slow grind. It is showing up again and again when nobody's clapping. And that's why it works. Now there's another major mistake beginners make. They think they need to invest a lot to start. But you do not need thousands of dollars. You can start with $10. You can start with $25. You can start with $50. And in 2026, most investing platforms let you buy fractional shares, meaning you don't need to buy a whole share of an expensive stock or fund. You can buy a piece. So the real question isn't, do I have enough money to invest? The question is, do I have the discipline to invest consistently? And that's what separates people who build wealth from people who stay stuck. Now, I want to give you the starter plan for a beginner. Let's pretend you're 10 years old and you want the simplest investing strategy possible. Here's what you do. You open a Roth IRA if you qualify and you want retirement investing. Or you open a brokerage account if you want flexible investing. Then you automatically invest a small amount every month into a broad index fund. That's it. And if you do that for years, you will be shocked at what happens. Because while your friends are out there chasing trends, the market is quietly building your future behind the scenes. Now, I want to bring up something important. Some people still feel overwhelmed even after all of this. And that's normal. Because personal finance is not taught in school. They teach you algebra, but not how money works. They teach you history, but not how wealth is built. And then society laughs at you for not knowing things nobody taught you. That is the real scam. But if you still feel overwhelmed, there is a tool that makes investing even easier. This is where robo-advisors come in. A robo-advisor is basically investing on autopilot. You answer a few questions about your goals and your risk tolerance. Then the robo-advisor builds you a diversified portfolio automatically. It's like Spotify for investing. Spotify watches what you listen to and builds you playlist. A robo-advisor looks at what you need and builds you a portfolio. It's not the cheapest option because they charge small fees, but for some beginners, it's a great way to start investing without fear. Now here's the most important part of this entire bundle. You need to start thinking like an owner. Because when you invest, you're not just buying numbers, you're buying pieces of companies. And those companies are out there selling products, earning money, growing revenue, paying employees, and expanding into the world. And while you're living your life, they're working. So your money stops sitting still, and it starts moving. That is the whole point. And in the next bundle, I'm going to expose the 3 biggest traps that destroy beginner investors. I'm going to show you how people get emotionally manipulated into losing money, how Wall Street makes investing look confusing on purpose, and how to build a strategy so simple you could teach it to a 10-year-old, and it would still beat most adults. Because once you understand what the game really is, you stop being a customer of the system, and you start becoming an owner. Now let's talk about the part nobody explains to beginners. Because this is where most people either get rich or get absolutely cooked. The stock market looks simple on the surface. You buy a stock, it goes up, you make money. You buy a stock, it goes down, you lose money. Easy, right? But behind the scenes, there are different games people are playing inside the same market. And if you don't know which game you're playing, you're going to lose before you even start. So I'm going to explain the main investing styles in the easiest way possible. Like I'm explaining it to a smart 10-year-old who just asked, how do people become millionaires from stocks? The first style is called buy and hold. This is the easiest, safest, and most common way normal people build wealth. Buy and hold is exactly what it sounds like. You buy great companies or index funds, and then you hold them for a long time, usually years or even decades. This is the style most millionaires use, because it doesn't require you to be a genius. It just requires consistency and patience. If the stock market is like planting a tree, buy and hold is planting it and letting it grow over time. You don't dig it up every week to check if it's taller. You let it grow. And when people say, the stock market is rigged, they usually don't mean this part. This part is actually fair. If the economy grows, the biggest businesses in the world grow. And if you own pieces of those businesses, you grow with them. The second style is dividend investing. This is where people invest in companies that pay them money just for owning the stock. It's like owning a rental property, but instead of collecting rent from tenants, you collect money from companies. And this is the part that blows people's minds. Because once you own dividend stocks, the company pays you without you doing anything. That dividend money goes straight into your investment account. This is what real passive income looks like. And it's why rich people love investing. Because while everyone else is trading time for money, investors are letting money create more money. And if you reinvest those dividends to buy more shares, those shares pay even more dividends. And then those dividends buy even more shares. That is the compounding effect. It's literally the closest thing to magic in finance. Now the third style is speculation. This is where it gets dangerous. Speculators buy risky stocks with the hope that the price will explode. Think of it like buying a cheap lottery ticket that might turn into something huge. This is the I'm going to find the next Tesla strategy. And yes, some people got filthy rich doing this. People who bought Tesla early became millionaires. People who bought Amazon early became millionaires. People who bought Bitcoin early became millionaires. But here's what nobody tells you. For every speculator who became rich, there are thousands who got wiped out investing in companies that failed, crashed, or got exposed as hype. Speculation is not investing. It is controlled gambling. And if you're new to the stock market, speculation is the fastest way to get traumatized financially, because the market can humble you quickly. And the fourth style is trading. This is the one that social media loves because trading looks cool. Trading is buying and selling frequently to make quick profit. Traders don't care if the company is good long-term. They care about price movement. This is where you see people staring at charts all day with candles and lines, and weird patterns like head and shoulders. Now don't get me wrong, trading can make money. Professional traders exist. But here's the issue. Trading is very hard for normal people because trading is not about intelligence. Trading is about emotional control. If you cannot control fear, greed, impatience, ego, and panic, you will lose money. And most beginners lose money trading, not because they're dumb, but because trading is psychological warfare. And in that war, most beginners don't realize something important. They're not trading against other beginners. They're trading against hedge funds, institutions, algorithms, and investors with more money than they could ever imagine. They're trading against billion-dollar machines designed to take money from impulsive people. And that is why beginners should not start by trading. You can learn it later. But if your goal is to build real wealth, the fastest path is not trying to outsmart Wall Street. The fastest path is to own pieces of the best companies on earth and let time do the work. Now here's the important part. The stock market is not a get-rich-quick machine. It is a get-rich-eventually machine. And if you want to win, you have to behave like an investor, not a gambler. You don't invest money you'll need next month. You don't buy random stocks because someone on TikTok said it's about to moon. You don't panic sell because red numbers scare you. Instead, you start with stable companies or index funds. You invest consistently, and you let time and compounding do what they were designed to do. And this is why most beginners should start with index funds. An index fund is basically a basket of many companies. It helps you diversify without needing to guess which one company will win. Because diversification is how you reduce risk. And here's the easiest way to explain it. If you bet everything on one horse, you're either going to win big or lose everything. But if you own the entire racetrack, you always win. That's what index funds are. And now that you understand the styles, the real question becomes this. How do you actually choose what to buy in the stock market without getting tricked, manipulated, or emotionally destroyed? Because in the next part, I'm going to show you how to pick investments like a real investor. What beginners should avoid at all costs, and the biggest lie Wall Street wants you to believe about risk. And once you understand that lie, you'll see the entire stock market differently. Before we go deeper into how to actually invest, we need to address one of the most overlooked problems that destroys beginners before they even start. And that problem is fear disguised as planning. Most people don't fail at investing because they are dumb or irresponsible. And they don't fail because the stock market is too complicated. They fail because they are scared to look stupid, scared to lose money, and scared to make the wrong choice, so they delay the process forever. They keep thinking they need to learn everything first, but the truth is that nobody learns investing by watching from the sidelines. You only learn it by participating in it, because real investing is not just knowledge, it is behavior. That is why the first mindset shift you need is to stop looking at investing like some elite club, where only Wall Street insiders are allowed to win. Investing is not a secret society, and the stock market is not a slot machine. It is simply a marketplace where ownership in businesses is bought and sold. If you understand that, then you start realizing something powerful, which is that investing is not risky in the way most people imagine. What is truly risky is staying broke while the cost of living rises every year, and your money loses value quietly through inflation. Inflation is one of the biggest enemies of people who never invest, because inflation does not scream at you, but it slowly steals your purchasing power year after year. The same money that used to buy you a full grocery cart now buys you a few bags, and the same paycheck that felt like enough 5 years ago suddenly feels like it is barely surviving. That is not because you suddenly became lazy, but because the system is designed to constantly increase prices while regular people are expected to somehow keep up. The reason investing matters is because investing is the closest thing regular people have to a wealth-building machine. When you invest, you are putting money into assets that have the ability to grow over time. You are no longer relying only on your job, your hours, or your physical energy. Instead, you are giving yourself a second worker, and that worker is your money. Over time, that money begins to compound, and compounding is what separates rich people from broke people more than intelligence, talent, or luck. Compounding is basically the snowball effect of money, because your money earns returns, and then those returns earn returns, and then those returns earn more returns. The longer you stay invested, the more powerful it becomes, and eventually, your money begins to grow faster than you can grow it with just working a job. That is why people who start investing early can build serious wealth, even if they never become famous, never start a business, and never win the lottery. They simply give time the chance to do the heavy lifting. Now here is where beginners usually get confused. They hear people say the stock market is risky, and they assume that risk means losing everything overnight. But the truth is that there are different types of risk. And the biggest risk for most beginners is not a market crash. The biggest risk is picking random stocks without understanding what they are doing, and then panic selling when prices drop. This is how beginners lose money, not because the market is evil, but because they let emotions drive their actions. This is why your first goal as a beginner should not be trying to get rich quickly. Your first goal should be learning how the market works while keeping things simple and safe. You want to build confidence, build consistency, and learn how to stay calm during ups and downs. The stock market rewards patience, not panic. And once you understand that, it becomes less scary and much more logical. So if you are a beginner, your goal should be to start investing with a strategy that is stable enough to survive volatility, simple enough to stick with long term, and diversified enough to protect you from the biggest beginner mistake, which is betting everything on a single company and hoping it saves your future. In the next part, we are going to break down the most important concept that makes investing make sense instantly. Because once you understand the difference between an account and an investment, the entire stock market becomes much easier than most people think. Now let us talk about one of the biggest reasons beginners feel confused when they first enter the stock market, because it is the exact place where most people mix up the account with an investment. And once you separate those two concepts in your mind, investing becomes about 10 times easier. Most people think investing begins with picking stocks like Apple, Tesla, or Microsoft. But the truth is that you cannot even buy a stock until your money has a place to live. And that place is called an investment account. Your investment account is not the investment itself, because the account is simply the container that holds the investment. The same way a wallet holds cash and a backpack holds books. When people don't understand this difference, they end up feeling lost, overwhelmed, and intimidated by all the jargon, because they think everything is the same thing when it's actually multiple steps. A simple way to understand this is by thinking about grocery shopping. When you go to a grocery store, the cart is not food, but you still need the cart to carry the food. In the stock market, your account is the shopping cart, and the investments are the groceries you choose to put inside it. If you skip the cart, you can't shop properly, and if you don't understand what the cart is, you end up grabbing random items without a plan and wondering why the experience feels stressful. That is why step 1 is always picking the account first, because the account determines the rules, the benefits, and how your money can be used later. This is important because there are different types of accounts, and even though they all look similar at first, they behave differently when it comes to taxes and access to your money. And taxes are a major part of investing that nobody likes talking about. But taxes can quietly eat away at your gains. Like termites in a wooden house, the first major type of account is the retirement account, which includes options like the Roth IRA, the traditional IRA, and workplace retirement plans like a 401k. Retirement accounts are popular because the government gives tax benefits to people who invest for their future, which is basically the government's way of saying, if you save and invest for retirement, we will reward you for being responsible. The trade-off is that retirement accounts usually come with rules that discourage you from pulling money out early. And depending on the type of account, you might owe penalties or taxes if you take money out before retirement age. The second type of investing account is an education-focused account, which includes plans like a 529. These accounts are designed to help parents invest money for a child's education, and they may provide tax advantages as long as the money is used for qualified education expenses. These accounts are valuable for families who want to plan ahead, but most beginners do not start here unless their primary goal is education savings. The third type of account is the most flexible for beginners, and it is called a regular brokerage account, also known as an individual brokerage account. This type of account does not have the retirement restrictions of a 401k or IRA, and it also does not limit you to education spending like a 529 plan. A regular brokerage account is like a blank canvas where you can invest and access the money whenever you want, although you may owe taxes on gains depending on your situation. At this point, most beginners ask the same question, which is, if a regular brokerage account gives me full freedom, then why would anyone use a retirement account? The answer is that retirement accounts have powerful tax benefits, and tax benefits can dramatically increase how fast your wealth grows over time. When you invest, your goal is not just to make money, but to keep as much of that money as possible. Because every dollar you lose to taxes is a dollar that can't compound for you year after year. Once you choose the account type, the next step is funding it, and this step is far simpler than people think. Funding your account just means transferring money from your bank account into your investment account, usually through a linked checking account. This part feels boring, but it matters because this is when your money leaves the sleeping world of bank accounts and enters the growth world of investing, where it can start working for you instead of just sitting still. After your account is funded, you reach the step that most people think is the whole point of investing, which is choosing what to invest in. This is where fear enters, because people picture Wall Street as a casino full of screaming gamblers, flashing stock tickers, and people losing everything overnight. But real investing is not about gambling, and the wealthiest investors in history did not build their fortune by trying to guess which stock will explode next week. The most powerful version of investing is boring, consistent, and long-term, because that is how compounding does its work. For beginners, the smartest and safest way to invest is to use index funds, ETFs, and mutual funds, because these are baskets of investments that give you diversification. Instead of putting all your money into one company and hoping it succeeds, you can buy into a basket that holds hundreds or even thousands of companies at once, which means your success is no longer dependent on one company doing well. Diversification matters because one company can fail, one industry can collapse, and one CEO can destroy a brand. But the overall market has historically continued rising over long periods because the world continues producing, innovating, and expanding. One last concept beginners must understand is the expense ratio, because it is a small, quiet fee that can steal your money over time without you even noticing. Even though many brokerages charge zero commissions now, many funds still charge annual fees for management, and those fees come out of your returns. Some funds charge almost nothing, while others charge a lot more for no good reason, and over decades. Even small differences can turn into a huge loss in total wealth. This is the moment where most people realize something powerful, which is that investing does not require genius, and it does not require predicting the future, because it mainly requires choosing the right structure, avoiding unnecessary fees, and staying consistent. The hardest part for most people is not the math, but the emotions, because they overthink. They panic, they chase hype, and they never start. And this leads to the most important lesson of this section, which is that you do not need to be perfect to start investing, because you only need to start. Many people spend years watching videos, reading comments, and collecting opinions like it's Pokemon, but they never actually put money into the market. And that delay becomes their biggest financial mistake. Inflation continues rising, the cost of living continues climbing, and time keeps moving forward whether you invest or not. Which is why doing nothing is often more dangerous than investing slowly and safely. In the next part, I'm going to show you the most beginner-friendly path for people who want to invest, but don't want to become a financial expert, because there is a simple set it and forget it strategy that allows you to build wealth without spending your life analyzing stocks. And once you understand that strategy, you'll realize something even more shocking. The rich are not winning because they are smarter than you. They are winning because they understand the rules earlier than you were ever taught. Now that you understand how accounts work and why diversification is the safest starting point, we need to talk about the actual styles of investing. Because the stock market is not just one single strategy. It is more like a whole world of different approaches, and depending on your personality, some styles are going to fit you better than others. The biggest mistake beginners make is thinking they need to act like professional traders. Because the internet makes trading look exciting. People post screenshots of huge wins. They brag about flipping stocks quickly. And it makes it feel like you are missing out if you are not doing the same thing. But what they don't show you is how often they lose, how much stress they are under, and how many people quietly go broke trying to copy that lifestyle. Real investing, the kind that builds wealth for normal people, usually works better when it is boring. The first investing style is buy and hold, which is exactly what it sounds like. You buy investments in strong companies or diversified funds and you hold them for years, sometimes decades. This style is powerful because it lets compounding work without you interrupting the process. It also reduces stress because you are not obsessing over daily price movements, and it lowers the chance that emotions will cause you to make bad decisions. The second style is dividend investing, which is when you invest in companies or funds that pay you cash just for owning the investment. Dividends can feel like passive income because money is paid into your account automatically. Many investors reinvest those dividends to buy more shares, and this creates a powerful loop. Because more shares create more dividends, and more dividends buy more shares. Over time, that can snowball into a serious income stream, even if you never become a high earner. The third style is speculation, and this is where things get dangerous for beginners. Speculation is when people invest in riskier, smaller companies or trendy assets because they believe the price will explode upward. Sometimes speculators get lucky, and when they do, it becomes a legendary story. You hear about the people who invested early in Tesla, Amazon, or Bitcoin, but you don't hear about the thousands of people who speculated on random companies that never recovered. Because those stories aren't glamorous, speculation can work, but it requires discipline, risk management, and emotional control, and most beginners do not have that yet. The fourth style is trading, which is buying and selling frequently in order to profit from short-term price movements. Trading is basically a completely different skill set than long-term investing. Because it requires deep knowledge, experience, and risk control, trading can make people rich, but it can also destroy people financially, especially when they are new. This is why the safest advice for beginners is to avoid trading with large amounts of money. If you ever want to learn trading, you should treat it like learning a sport, because you practice first. You start small, and you accept that mistakes are part of the process. If you are a beginner, and you want the best chance of success, the smartest path is to focus on long-term investing. Through diversified funds, you can still build wealth, you can still make strong returns, and you can still benefit from the growth of the stock market without trying to compete with professionals who do this all day for a living. This is where index funds become a cheat code for beginners, because index funds allow you to invest in the overall market instead of betting on individual winners. An index fund can track hundreds of top companies at once, meaning you automatically spread your risk. This protects you from the disaster scenario where you put money into one company, and then that company crashes due to a scandal, bad leadership, or a sudden industry shift. With index funds, you are investing in the bigger story of economic growth instead of the drama of a single company. Another reason index funds are powerful is that they remove the need to predict the future. Most people think investing means guessing which company will win, but index funds flip the game, because you are investing in the belief that the overall market will rise over time. Historically, the market has grown because society keeps innovating, businesses keep expanding, and the economy keeps evolving. That does not mean there are no crashes, but it does mean that long-term investors who stay consistent are often rewarded for patience. Now here is the key takeaway that changes everything. The stock market is not designed to reward the smartest person in the room. It rewards the most consistent person in the room. The person who keeps investing through good times and bad times usually beats the person who tries to time everything perfectly, because timing the market is extremely difficult even for professionals. In the next part, we are going to tie everything together with a simple beginner roadmap, so you know exactly how to start investing step by step without confusion. And once you see the roadmap, you will realize that investing is not complicated at all, because the system only looks confusing until you understand its basic structure. Now that you understand the main investing styles, and why long-term investing usually beats trying to outsmart the market, we need to talk about the most important thing beginners forget. The stock market is not just about picking investments. It is about building a system that keeps you investing even when life gets messy. Because the truth is, most people already know the basics. They know they should invest. They know investing builds wealth. They know holding long-term is smarter than gambling. But they still do not do it consistently. Not because they lack information, but because they do not have structure. This is why the real secret behind investing is not a secret stock pick. It is automation and discipline. The richest investors are not always the smartest people in the room. They are often just the most consistent people in the room. They invest in every season, every year, every market cycle, even when the news is scary, even when the world feels unstable, even when the internet is yelling, crash incoming. And here is why that consistency matters so much. When you invest regularly, you're doing something called dollar cost averaging, which basically means you are buying shares at different price points over time. Some months you buy when prices are high, and some months you buy when prices are low. But over the long run, those prices average out, and you end up building a position without needing to guess the perfect moment to buy. That matters because most beginners think investing is about timing. They think they have to wait for the right moment, the right dip, the right crash, the right signal. They start telling themselves, I'll invest after the market drops, but the market keeps rising, so they stay out. Then when the market finally drops, they panic because everything feels like it is falling apart, so they still stay out. And by the time the market recovers, they have missed the best growth period, because the biggest gains often happen during the recovery, not during the good news. So you need to understand this. The stock market is a machine that punishes fear and rewards patience. The market does not care about your emotions. The market does not care if you feel ready. It does not wait for your confidence. That is why your goal as a beginner is to remove as much emotion as possible from the process. The simplest way to do that is automation. You set a recurring transfer, like every payday or every month, and the money moves into your investing account automatically. Then you set it to buy your diversified funds automatically. That way you are investing even when you feel lazy, even when you are stressed, even when you are busy. The investing happens quietly in the background, and your future self benefits from it. This is one of the biggest differences between people who build wealth and people who stay stuck. Wealthy investors have systems, broke investors have moods, and moods are unreliable. Because moods change with the news, the economy, and emotions. Systems keep working no matter how you feel. Now we need to talk about the one thing that makes beginners more confused than anything else, and that is the fear of losing money. This fear is real, and it is not stupid. Nobody wants to work hard and watch their money disappear. But the problem is that most people misunderstand what losing money actually means in the stock market. If you invest $1,000 and your account drops to $900, you have not truly lost money unless you sell. You are down temporarily on paper. But paper losses do not become real losses until you lock them in. The stock market moves up and down like waves. That is normal. What matters is the long-term direction. The reason this is so important is because beginners panic at the worst possible moments. When prices drop, the news gets dramatic. People start throwing around words like recession, collapse, crash, depression. It feels like the world is ending. But what is actually happening is that the market is giving discounts. The best investors in the world do not fear market dips. They prepare for them, because dips are when great investments become cheaper. Think about it like this. If your favorite sneakers went on sale, you would not panic. You would be excited. You would say, this is the perfect time to buy. But when investments go on sale, people get scared because they assume the lower price means danger. In reality, lower prices can be opportunities, especially when you are investing in diversified funds that represent large parts of the economy. This is why many long-term investors actually become wealthy during recessions, because recessions are painful emotionally, but financially, they often create the best long-term entry points. Investors who stay consistent during downturns end up buying more shares for the same amount of money, which means when the market recovers, their growth multiplies. Now, of course, this depends on what you invest in. If you gamble on random speculative companies, then yes, some of them might never recover. But if you invest in broad index funds tied to major companies and long-term economic growth, history shows that markets tend to recover over long enough time periods. That is why long-term investing is not about being fearless. It is about being prepared. The biggest mindset shift you need is this. Volatility is not the enemy. Volatility is the price of admission. If you want the long-term reward of investing, you have to accept the short-term chaos that comes with it. Now let's talk about the part most beginner videos skip. because it is not as exciting as stocks, but it is what actually protects you. Risk management. Risk management simply means you do not put yourself in a position where one bad move destroys your life. It means you do not invest money you need next month. It means you do not invest rent money. It means you do not invest grocery money. It means you do not invest emergency money. It means you do not invest money that you will panic over if it drops. This is why having an emergency fund matters even before investing. Because an emergency fund is what keeps you from selling investments at the worst possible moment. Without an emergency fund, any unexpected expense becomes an emergency, and you may be forced to sell your investments when the market is down, which turns temporary dips into permanent losses. So the smartest beginner structure is this. You build emergency savings first, then you invest consistently. That way you can survive life without interrupting your portfolio. Another part of risk management is diversification, which we already covered. But let me say it clearly. Diversification is your protection against uncertainty. Nobody can predict the future perfectly. Not you, not your favorite YouTuber, not hedge funds, not billionaires. Diversification is you admitting that you cannot predict the perfect winner. So instead, you invest in a collection of winners. This is why index funds are so powerful. They are diversification in one purchase. You are investing in hundreds or thousands of companies at once. You do not need to guess which single company will dominate. You only need the overall market to keep moving forward over time, and historically, that has been a winning bet over long periods. This is also why you should avoid falling in love with a stock. Beginners tend to emotionally attach themselves to certain companies. They will defend it like a sports team, like it is their identity. But investing is not about loyalty. It is about reality. Companies can change. Industries can shift. Leadership can fail. Even great companies can become bad investments at the wrong price. As a beginner, you want to stay grounded. You want to build a portfolio that can survive both good times and bad times. You want a strategy that does not require perfection to succeed. Now that we have covered mindset, structure, consistency, and protection, we can finally answer the biggest beginner question in a way that actually works. What should you buy? The honest answer is that the best beginner strategy is not choosing individual stocks. It is choosing broad, diversified funds, especially index funds. This is because individual stock investing requires deeper research, more emotional control, and more discipline. It is possible to win with individual stocks, but it is harder, and the consequences of a beginner mistake are bigger. Index funds reduce the complexity while still allowing you to participate in growth. If you want the simplest beginner setup, you can think of it like this. You choose one strong index fund, like an S&P 500 fund or a total market fund, and you start investing into that consistently. Over time, you will own small pieces of hundreds of companies, and you will be investing in the long-term growth of the economy. This approach is boring, but boring is powerful. Boring is how wealth is built. Most people imagine wealthy investors doing complicated strategies, but a huge amount of wealth has been built through simple long-term consistent investing. Now, if you want to expand beyond that later, you can diversify into more funds, like international exposure, or total world index fund, or tech-heavy index funds. But the beginner move is to start simple and stay consistent. Because the biggest danger for beginners is not starting to small. The biggest danger is starting to complicated. Complicated strategies make beginners stop. Simple strategies keep beginners going. And the investor who keeps going is the investor who wins. Now let me give you the clean beginner roadmap that ties everything together. Because if you follow this roadmap, you will be ahead of most people even if you never become obsessed with investing. The first step is to choose an investing account. If your job offers a retirement plan like a 401k, that is a powerful tool, especially if your employer matches contributions, because that match is essentially free money. If you qualify for a Roth IRA, that is another great option because it can grow tax-free under certain conditions. If you want flexibility and access, you can use a brokerage account. Each account has pros and cons, but the point is you start with the right container. The second step is to fund the account. This means transferring money inconsistently, weekly, bi-weekly, or monthly. The actual schedule matters less than consistency. If you only invest once in a while, you will not build momentum. Momentum is everything. The third step is choosing investments. For most beginners, the safest way is diversified index funds. That is how you build a foundation. The fourth step is automation. You want the system to work without requiring motivation. Motivation fades. Automation wins. The fifth step is staying calm. You will see your portfolio go up. You will see it go down. That is normal. You do not panic. You do not stop. You keep investing consistently and let time do the heavy lifting. If you do these 5 steps, You are already playing the game at a higher level than most people, because most people never even start. And now, I want you to remember the most important truth about investing, because this is where beginners either win or lose. Investing is not about being perfect, it is about being consistent. You do not need to be a genius. You do not need to be a trader. You do not need to predict the future. You do not need to know the next Tesla or the next Amazon. You only need to build a system, stay consistent, and let time compound your effort into wealth. Because investing is one of the only games on earth where patience is rewarded like a superpower. If you invest consistently over years, you start living in a different reality than people who never invest. Your money starts working harder than your job. Your future becomes more stable. Your freedom becomes more real. And eventually, you stop being controlled by financial fear. So if this video made investing feel simpler than it ever has before, do me a favor and hit the like button, because it helps the algorithm push this to more people who are still confused and overwhelmed. And if you want more videos that explain money, investing, and the economy in a way that actually makes sense, subscribe to the channel. Because we are building a community of people who refuse to stay broke, just because nobody taught them the rules. And before you go, I want you to comment this: I'm starting. Because once you say it, you make it real. And once you make it real, the next step becomes easier.